Uh, the workshop is designed to enlighten beginner traders as well as traders who's been in the market and are looking for more clarity as to what Forex is all about in general. I do see a couple of questions here as well in regards to trend continuation. We will talk about all that later. In the meantime, this Forex webinar today, it's all about terminologies. We're gonna go through a couple of terminologies, and then we're gonna deal with the questions a bit later. Let's get started now. Okay. Forex terminology. We're going to get started by explaining sport Forex, looking at Forex in general and the opposite. Sport Forex, essentially the Forex as we know it, um, is a marketplace where you're able to get your transactions done at the time when you hit the button. Spot Forex or spot market means a market in which currencies are immediately exchanged on the spot and delivered at cash price or conversion rate. So you're clicking a buy or sell button and you're getting your order as you do. Now, an example of that would be, say, for example, you're exchanging Swiss franc for the US dollar at the bank. You are indeed making a spot transaction. And note, the opposite side is just futures, where you're getting currencies at the exchange at a later date. As traders, we do find spot forex to be much more interesting, exciting, because you're getting it on the spot, and that's where most traders tend to fall. Futures have low liquidity in the sense that you're talking about future prices. Now let's go straight to pip percentage in point. Um, Pip percentage in point. Well, if you're an experienced trader and you do trade, you do understand what a pip is. Nonetheless, a pip is always the second smallest increment in any currency pair. Well, the second smallest starting from the right. Now, knowing the location of the pip is key to determining how far a currency pair has moved. If a pip value, say you're looking on a chart and you see the price, I'll pull up a chart. Okay, there we go. Now, looking at this chart, if you look to the extreme right, you see a quote price. Now, you see a quote price because you're looking at a chart of euro US dollar. So it means that the first currency, which is the euro, is the base, the US dollar, the quote, which means for 1 euro, this is the amount of dollars you will get to the extreme right. Now, if you'd notice, there are 5 digits after the decimal. Now, 5 digits after the decimal, the fourth digit from the right, the second digit from the right, the fourth from the left, uh, is a full pip. We see right now 8. 8 is a full pip. Now, if the market price goes from where it is right now and it dips slightly lower, let's say it dips a few pips away, the difference essentially starts to count from that 8. So if the market goes down, say for example, from this value here, 39, what we have. If the 3 drops down to 1, market just moved by 2 pips. Pretty much easy. Once you start trading, you're able to detect when the pip value moves. Now, the fact of the matter is that smallest increment in price or decrement is where the money is. It's literally tells you what your trade is worth. In general, all currency pairs except those that have the Japanese yen will have the pip in the fourth decimal. What is that saying? When you're looking at a pair with a Japanese yen, for example, the US dollar JPY, now it's quite different. What we see here essentially is 3 digits after the decimal and not 5. Now, on the spot here, the pip does count from the second, from the left or from the right, from the number 9. Now, if 9 drops down to, let's say, maybe 7, then you've got approximately 2 pip lower. Now, that is how the market moves. Now, traders note that when you're trading with shares here in EverFX, you can indeed trade stocks and shares. And when you're trading with shares, These are noted by pennies, futures ticks, and forex pips. Basically, the smallest increment that does matter to you when in terms of value and money. And pips are approximately 1/100 of of a cent, about 1%. Okay. Now, this is exactly what we just saw on the platform. Now, when you're looking at this is one pip, one full pip, and that's the fourth digit from the left, second from the right after decimal. Now, when you look down for the yen pairs, you've got actually the second digit is what matters there. Now, when this value moves, you're either in a profit or you're in a loss. That's exactly how it happens. Now, we will go further and explain lot sizes. Let's call lots a uniform unit of measurement for determining volume in this market. Now, it's very important to understand what lots are, because if you're a trader, it's very important to understand your input and your output. A lot of traders trade without understanding what they put in and what you expect to get out. How then can you have a target? How then can you create a strategy? Lots is very important because it's a uniform language. Every trader uh, knows. It's essentially how we determine how much we have in the market, the value of the asset we're partaking in. So a unit of measurement for position size is similar to a share or a contract for futures. A lot can be referred to as the number of currency units you will buy or sell, the size of your trade. Now, you've got three different sizes. I mean, lots are broken down into three different sizes. You've got a standard lot denoted as 1, a mini lot noted as zero point 0.1, a micro lot noted as a 0.01. Now, obviously, 100,000 units of the base currency, meaning that if you're trading a currency pair, um, the amount you put in is always in the base. Now, if you're trading a US dollar Japanese yen pair, for example, you're talking about $100,000. Now, you can always reduce the size of the trade you open, but the beautiful thing about CFD trading and Forex trading, it comes with a leverage. So you don't actually need that $100,000 because the broker provides you with a leverage. Leverage is important. Now, when you trade in Forex as well, I've got a couple of questions here. We will go through the questions once we're done with this right here. Traders should also note Forex platforms vary on how they accept position sizes. For example, some brokers might give you a platform where, in order for you to understand how much volume you're putting in, it's going to be in units. So you will see 1,000 units, for example, or you could see a micro lot. That's a 0.01. And let's look at that here. Okay, let's activate the one click trade. Okay, there we go. Deactivated. Now, okay. Let's just give it a minute. And what I would like you to see, say for example, I will, okay, let's get back on here. Now, if you're looking at a trader that gives you its size in positions by the number and standard lot sizes, be well aware that the leverage is also very important as to what you have in trading. A couple of these terminologies are what we're going to deal with now. Nonetheless, This webinar is designed to enlighten you. You are entitled to a one-on-one support from an account manager here in EverFX. All you need is a request for one, and they'll show it to you. Now, from lot sizes, we will go over to looking at things in a bit more larger perspective. So pip value, first would say pip value is calculated by taking the amount of currency that you open multiplied by the price of the currency itself. In simple words, once you determine your input, you want to look at your output. Now, if your input is approximately 1,000 units, say $1,000 of a micro lot, and you've got a leverage of say a 1 to 100, essentially you'd understand that all you need would be $10 to acquire a micro lot. Now, if you've got a leverage, if you're working with a leverage of say 1 to 100, for example, in order for you to acquire $1,000, which we know is a 0.01. Okay, now with a 1 to 100 leverage, $1,000 you would need approximately $10. Okay, to get a micro lot. Now this is a micro lot. Now, some brokers might give you a platform where rather than having them in lot positions, you'd actually have them in the real value for the market. Now, this is for the lot. If you're going for a one standard lot, and we know that a one standard lot is approximately $100,000 in the market. Now, if you have a leverage of, let's say, a 1 to 100, essentially to acquire one lot, all you would need to do that would be 100,000 divided by 100. You're trying to see exactly how much of 100 you've got there, and what you'll be needing to acquire 100,000 will be $1,000. Now, leverage is one of the major characteristics of trading Forex and trading CFDs. It's all about the leverage. Okay. And now, when you put in a size in the market, you're thinking about what are you getting in return for that trade that you open. Now, pip value is calculated by taking the amount of currency all lots multiplied by the price. Now, for example, if you open a one lot size as we see here, example one lot US dollar CHF, that's what you're trading. You open a one lot. We do know that a one lot is approximately 100,000 in the market, and the market moves by 1 pip. We know 1 pip is the fourth digit as we see here, one. That's approximately 10 CHF pip value that you made. Remember, the profit is in the quote currency, and the amount you're putting in, the margin is in the base currency. So 10 CHF, once you convert that into US dollar at this rate, you've got about 12.58 US dollars. Now that's how the market works. Now, using a pip calculator is the easiest and fastest way to calculate the value of pips. EverFX will assign you a one-on-one personnel that will teach you how to understand pip calculation. Okay, now let's go into margin. Now, what have we looked at? The pip is your output. We've looked at the output. We've looked at the input. You put in what you put in, the value of what you put in, the size of what you put in the market. It's essential to any strategy. Every strategy needs a target. Without a target, it's worthless. It needs to be substantial. So you need to understand your input. You need to understand your output. By understanding your input, then you're understanding how your risk management will play out. Now, at the end of the day, if you want to open a micro position like we see here, 1,000 units, and you've got 1 to 100 leverage, that's about $10 input on that trade. Now, for that value, what are you getting in return? That's where the pip comes in. Now we're over in margin. Now, margin is the deposit required to open or maintain a position, just like we did here. The margin is what is required to open. Now, this value right here would be your margin. This value right here would be your margin. You need $10 to open a position worth $1,000. Okay, a micro position, it's about $1,000. What you need will be about $10. Why? Because you're getting a leverage of 1 to 100. Okay, now a margin would be this right here. So a margin would be essentially what you're putting into the market and against what you're getting out of it. On this trade right here, one standard lot with a leverage of 1 to 100, this would be your margin. Very, very important. Now, brokers typically will allow you a 1 to 50 leverage. Now, not a 1 to 100, but a 1 to 50. This means that the margin, the funds required to open a position will be lower by 50 times, just as the the amount needed to open positions, this positions is 100 times lower. It says $1,000, but all you needed was about $10. It's 100 times lower the amount. Why? Because you've got a leverage. Your margin is lower. Your margin here as well, it's lower. That's essentially what it's talking about here. The broker typically will allow you a 1 to 50 leverage by default. You need a high leverage request, and if you have a certain level in understanding, you might be approved on your leverage. Now, this means that the margin funds required to open a position will be 50 times lower than what you would normally have required. Now, margin is then calculated by taking the contract size, just like we saw. You're taking the contract size. We've seen it all right here. This is the contract size. If you're opening one lot, 100,000 becomes your contract size. If 100,000 is your contract size, essentially what you're doing is you're dividing it by the leverage and you're getting exactly what your margin for that trade is. Now, let's look slightly into currency pair. I mean, we're talking to beginners, we're talking to um, beginner traders here. Now, before we move on, I'd like to go to a couple of questions and answer some questions, and would move on. For lengthy questions, we'll deal with that in the email. Please raise your hands from now. Let's take a quick short break. Raise your hands. Let's go through a couple of questions, go through a couple of things we've done previously. Um, Okay, now let's see. I've got a question here saying, um, give me a minute. There we go. We've got Joseph. Joseph is Australian. Joseph, nice for you to join us. It's quite late in Australia right now. Nonetheless, I'll take your question first, Joseph. Okay. Okay, let's go exactly. Joseph is asking in regards to PIP. Now, Joseph question says, when you in counting your PIP, does it matter the size of the trade you open? Are you still making the same or losing the same? Well, Joseph, yes, absolutely. It does matter the size of position you open. Essentially, a one standard lot, like we looked at here, 100,000 units, which is a standard lot. Now, for a standard lot, when you come to the amount of the amount of money your potential return or loss on a standard lot, it's about $10. Now, a standard lot is saying 100,000 units. Now, 100,000 unit, once the one pip moves, a full pip move, the fourth digit from the left. Now, once that moves, that's about $10, Joseph. Now, take, for example, a person who goes lower. Say, for example, I open up a mini lot and not a standard lot. Now, a mini lot is about 10,000 units, so I'm actually opening lesser volume, not as big as the standard lot volume. Now, when you look at that, you'd see that I'll be making $1. Now, if a standard lot makes you about $10 for every one of this pip that moves, the fourth digit moves, or with the yen pairs, the second digit moves. If it moves, you're making approximately $10 if you were opening a standard lot. Okay. Now, if you were opening a mini lot, though, that'd be a zero less. That'd be $1 in profit or loss for every time the market moves. Profit or loss, why is that? Obviously, it depends on the size of your trade. If you open in a buy position on the market going up, you're making profit then. Now, yes, Joseph, if you're on a micro lot, that'd be about 10 cents for every pip that moves. So in order to answer your question, yes, This is exactly how it does count. I've got another question from Jonathan. Jonathan from Ghana. Basically, Jonathan is asking how can he start trading, and do you have to download an app? Yes, if you're using a mobile phone, there's something called the mobile trader. It's a mobile platform designed to be compatible with every mobile phone. You just need to download the MT4 from a Google Play Store, an app. Download the MT4 and you can proceed from there. But Jonathan, I would recommend you get in touch with an account manager in order to guide you through, so you don't have to do anything alone, all by yourself while you're here in EverFX. Okay, great. Now I will continue, and we will go through a couple more questions a bit later. Now we're going to a slightly more interesting side of trading. Um, I'd like some audience. Please raise your hand if you may. Just make sure you understand how to use the functionality on the software. If you're using a laptop, to the to the left hand corner, you should see the raise your hand tab. Great, great. I see a lot of hands being raised. Fantastic. Okay, amazing. So if you've got any question as well, please drop your question through. We're going to deal with it together as a team, as a unit. It's a very interactive session. We've got approximately, right now, we're on 186 people in audience. And Zachariah says hello. Hello, Zachariah, to everybody. Please feel free to drop a question or two. Patel has got quite a lengthy question. And Patel, in regards to your questions, I would say Patel is saying terminologies, trend reversal and trend retracement. Well, trend reversal and trend retracement, Patel, is basically not on the topic for tonight. So what I will do, Patel, is I'll tend to your question on a one-on-one base. Please send me an email and we can schedule an appointment, Patel. That's one of the perks of being in this webinar. You'll be able to have a one-on-one time directly with me, and not any other account manager or broker. Now, let's move on. I've also got a question from Duckworth, but I'll take care of that a bit later. Great. Now let's go to the more interesting side of things. Currency pairs. Wow. Currency pairs. Well, we have to have two currencies in order to make a trade, right? At the end of the day, it's like buying a house. I mean, you're giving, let's say you're giving $100,000, but you're getting something in return. You're getting a house. I mean, you need two currencies in order to be able to make an exchange, because you're letting go of one and you're acquiring the other one. You're essentially buying one. Well, you're always buying the base currency if you're hitting on the buy button, and you're always selling the base currency if you're hitting on the sell button. Whatever you do affects the base currency. Now, if you're buying, then you're essentially buying the base and you're selling the quote. If you're selling, you're essentially selling the base and you're buying the quote. Now, let's look at the base currency. Well, the base currency is always the first currency in the pair with a value always equal to 1. Yes, it is always equal to 1. If we look on this chart, for example, I'm looking at a chart of the pound US dollar. Now, the pound US dollar right now, essentially, I'd say for £1, the quote price is to the right-hand side. This is the quote. Now, for £1, it's approximately 1.32010 US dollars. It's got 5 digits after the decimal. Remember, your pip value is the fourth. That's basically one full pip. For one lot open, that's about $10. For a mini lot, smaller value, that's about $1. Micro lot, about 10 cents. Now, the right-hand side has got the quote price. So you got one British pound for this amount in US dollars. Same goes with every currency pair. Now, the quote price, quote currency rather, the second currency in the pair, also known as a counter currency. And the amount of the quote currency it takes to buy 1 unit of the base currency. That's usually the price. Say, for example, a person says, hey, what's the price on euro US dollar? He's essentially saying, well, what is the quote price? In the example we have here is 1.54562 US dollars to get 1 euro. Okay, now let's go a bit further. Currency pairs. You know, most traders look at a Forex pair the same way, a currency chart, the same way you'd look at a gold chart. Well, that's actually wrong. This is a currency chart. Now, on a currency chart, the exact same way you see, okay, it's not an active account. Let's go straight to gold. Here you got your currency pairs, you got majors, minors, so many pairs. And here you got your commodities, and there you got gold. So when you're looking at a currency pair, or you're looking at a commodity pair, a single standalone currency, it's quite different. Those of us that are quite used to trading stocks and shares, when you get a stock price at $10 today, and tomorrow it's at $20, and the next day it's at $30, it's quite different when you're looking at a currency pair, because you've got two standalone assets in one pair, in one chart. On one chart, you've got two standalone currencies, which means as a pair moves lower, the base currency is less expensive versus the quote currency. What does that mean? As the pair moves lower, the base is less expensive. As this chart moves upwards, the base becomes more expensive for the quote, because it goes, say, for example, from 1 to 10. So it means that for one of the base, I used to get 1 to 1, and now I'm getting 1 to 10. Now, essentially, it's getting much more expensive. Now, if you look at it, vice versa is the case. If the pair goes down, you could say the base pair is getting less expensive than the quote. The strategic action would be to look to buy the pair if you think it's going higher, look to sell the pair if you think it's going lower. So if you've got a chart where you've got the market going higher, you're looking to buy in this trade before it goes up. If the chart is vice versa the case, going down, you're looking to sell before it goes down. That's essentially the idea. Um, if you think about it, this is how you would buy or sell anything. I mean, say your house is quoted in US dollars and it costs 400,000 US dollars. When you bought your home, I mean, you literally exchange 400,000 for one house. It's an exchange right there. But this time around, we're talking about currency exchange, Forex. Now, if you sell your house vice versa, you're selling your house, one house for $400,000. So to sell the pair is to sell the base. Simultaneously, you're buying the quote. So you're selling the base, buying the quote, and vice versa the case as well. Now, looking at major currency pairs. Well, how does a currency pair qualify by being a major? I'll tell you. First and first, it's got to have the US dollars. Well, you've got to have the US dollars to qualify as a major. Why? Because the US dollar is the world's most traded currency. I mean, literally 40 to 50% of every investor's portfolio has got the dollar involved. There's a high level of liquidity in the dollars. You can get your buy, you can get your sell with the dollar. And when you're talking about euro US dollar, nickname fiber. Okay. Now, when you're talking about the fiber is the most traded currency pair on the planet. At the end of the day, its volume alone accounts for close to 30% of everything of all currency pair traded. It's huge. The golfer is a big one as well. That's the US dollar JPY. Very highly traded. As Japanese yen is considered a safe haven. US dollar highly traded. Tokyo is the third largest market on the planet, and at the end of the day, all of Asia connects straight to Tokyo. So we're looking at pound sterling, otherwise called cable, the pound and the dollar. That's a major as well. They're all majors because they got the dollar. Essentially, you've got 8 major economies. economy starting from the euro, British pound. You've got the Australian dollar, the New Zealand dollar. You've got the US dollar. You've got the Swiss franc, the Canadian yen, Swiss franc, and Japanese. Canadian dollars, the Swiss franc, and the yen. Now, if you combine them all with the dollar, you get a major. You've got cable, you've got Aussie, you've got Swizzy, the Loonie, and Kiwi as well. Okay. Now, combining 8 majors with the dollar, you'd get about 7 major currency pairs. And now we're looking at minors. Basically, the definition of a minor currency pair is a currency pair without the dollar. Now, if you're looking at all 8 majors that were mentioned, when you combine all 8 of them without the US dollar, you've got minors. Now, minor currency pairs are quite a lot because you could pair up the euro with a pound, you could pair up the euro with a CHF, you could pair up the euro with the Australian dollar. I mean, you could do vice versa as well, pair up the pound with either one of them as well. Okay. Now, let's look at a couple of characteristics in regards to pairs, a very notable one. Now, in general, a currency is more liquid and active when its country of origin is in normal business hours. What are we saying in essence? Every region has working hours. Say, for example, 8 a.m. in London might be a different time to where you are, but that's when the pound is most active because the market is open in London, and until it closes, you've got a very active market with lots of liquidity here and there. A lot of buy and sell orders makes it much more convenient for you as well as a trader. Now, the American market as well, at the time of open, might be a different time where you are, but that's when supposedly, theoretically, the dollar gets much more volatile. Now, cross pairs are great for non correlated trading opportunities. Cross pair talking about minor currency pairs. Now, minor currency pairs are great when you aren't looking for correlated trading opportunities. What does that mean? Since every major pair has got the dollar, there's something correlating all major pairs, and it's the dollar. Now, the minors are not like that. A minor currency pair can be either one of the 7, except the dollar, majors combining each other. Now, since they don't have much correlated trading opportunities, as well as finding out the strengths or weaknesses of individual currency, that's a good one. Now, the Japanese yen and the Swiss franc are generally considered safe haven currencies. Safe haven currencies are usually they usually rise when there's global economic or political risk, when there's uncertainty when it comes to other currency pairs. If eurozone continues as much stimulus as it's doing, and things become uneasy in Europe, you'd have a lot of traders demanding the yen and the CHF, safe havens. Now, treat every currency pair as its own unique instrument. Do not trade them like you were trading gold. If you trade in gold, for example, I mean, it's just gold. The price you get on gold today and tomorrow, relatively, it's just for one instrument. But the exchange rate, when you're looking at a chart, there's got 2 standalone currencies. I mean, you're looking at currency pairs, but at the end of the day, they're segregated economies. Now, you do need to treat them as their own unique instrument. It has correlation to other pairs, but it will also have its own identifiable personality. For example, the US dollar. You got a tax cut. There was a tax cut which was passed into legislation, an overhaul of the taxing system that took the corporate tax in United States from 35% to 21%, December 29, just a couple of weeks back. Now you got US equities on a rise, you got the US dollar dropping in value. Now, what are we saying in essence? That is its own identifiable personality. If you're trading on the euro dollar, I mean, the corporate tax cut didn't, well, it did affect the euro indirectly, but it was on the US dollar. So at the end of the day, you're taking that trait, you're taking that identifiable personality of that economy, and that's how you trade. Now, a good trader knows the characteristics of their currency pairs. Very, very good one right there. Get in touch with your account manager. It'd be good to broaden your horizon when it comes to currency pairs and how to sort out the right currency for your trade, how to pinpoint the exact time when you've got a little bit of volatility. Remember, nothing is absolute, but the whole point is you want to get as close as being right as possible. Okay, you're gonna need all the help you can get. EverFX will provide that for you. Now I've got a slight I've got something here I'd like the viewers to take a note of. Right now, you've got cash accounts, and the opposite of a cash account would be obviously a margin account. Now let's look at a cash account and a margin account. Now a cash account would be what we're used to. In a cash account, you're only able to use the money you deposit into your account. Say, for example, you made a deposit of $1,000. Well, if an ounce of gold is $1,000, well, that's it. All you can go for is just 1 ounce of gold. Why? Because it's $1,000. Now, the difference with a margin is with a leverage, you can actually get much more than 1 ounce. How does it work? If 1 ounce of gold is about $1,000 and you're getting a leverage of 1 to 100, let's put it on here. Okay, I'll just take all this out, and let's say we've got gold price at about $1,000. Now, if gold price is at about $1,000 per ounce, by the way, okay, and with a cash account, you would need $1,000 to get 1 ounce. But if you were trading on a margin account, which means you're trading with a broker, and your broker provides you with a leverage. Excuse my typo right there. Okay, provides you with a leverage of, say, 1 to 100. Now you've got a leverage of 1 to 100, and gold price is at $1,000 per ounce. Now the first thing you're asking yourself is, well, if I got $2, well, the broker is making it 200, right? Okay, if I got $3, well, the broker is making it 300, right? Great. Well, if I've got $4, the broker is making it 400. Amazing. So essentially, if I had $10, I'd be able to get me an ounce of gold. Now, with $10, you'd be able to get an ounce of gold. Now, the whole idea is if with $10, you're able to get an ounce of gold, with a cash account, all you can get will be just 1 ounce. But if you had, excuse my typo, I've got big fingers and I tend to go for 2 buttons at the same time. Okay, now if you've got a margin account, now with a margin account, if you're getting 1 ounce for $10, how many ounces can you get if you've got $1,000 in your account? That's the whole point to trading CFDs, to trading leverage. Now, understand this: in as much as you will be able to make your returns will be more than your estimated margin value. I mean, you're getting an ounce of gold, and an ounce of gold moves up by 10 cents. That's a profit made for you on that trade. But also, your losses will be amounted as the same. It's a two-sided. It's a two-sided thing. I mean, you've got the chance for return. You could also make a loss. Now, the whole point is for you to have the assistance to understand and be able to make a decisive trade, a more enlightened trade. Okay, so you do need assistance. Going through this webinar is no magic path to becoming a successful trader. It's designed to enlighten you and get you to know, understand what exactly you wish to know and what exactly you wish to, how you wish to move on in this market. Now, cash accounts, you are not allowed to borrow money with cash accounts. You could call leverage a sort of borrowing money, because if the brokerage is giving you, say, a 1 to 100, you're asking yourself, is this brokerage in love with me? Why is he giving me 1 to 100? What am I, his best pal? Well, that's not essentially how it works. It's a banking system. The whole idea is for you to make $10, you need quite a lot of capital. Now, a leverage gives you that access to trade CFDs, which means you're in a contract between a buyer and a seller that's got the same conditions as you do, and basically you're stipulating for a derivative, which is the value on the trade. So it is a banking system, and that's how it works. That's how it's designed to work. Now, you're not short, you can't not short securities in a cash account, which means you cannot open a sell position and expect to make profit. Well, in CFDs, you can. You can open a sell position on a trade that is going lower. Um, as we can see here, you do open a sell before the trade goes down, and you will be in a return. So you've got a two-sided market there as well. Now, if we look at a margin account, advantage of a margin account, which is Forex, which is CFDs, which is what EverFX provides you with. A higher leverage can amplify your losses. Okay, yes, it can, because for $10, you're getting 1 ounce of gold. So if the price moves, yes, it can amplify your losses as well as your profit. Now, with a margin account, you're essentially increasing the value of your deposit for trading purposes. So with a margin account, you're increasing the value of your deposit for trading purposes. You pay interest on many leverage positions carried overnight. Now, when it comes to the interest, they're called swaps. The banks do charge you overnight when you leave trades open. Speak to an account manager and he'll break it down to you. Now, with EverFX, all accounts use some leverage unless you choose otherwise. Now, all accounts have got leverage. You wish to choose otherwise, definitely. Now, fundamentals and technical analysis, just to brief things up and to just brush up on all this really fast. Fundamental analysis involves analyzing relevant macroeconomic factors. We will have a webinar looking broadly and more in depth into fundamentals and technicals. In the meantime, just a quick rush through. Based on overall financial health of a company or an economy, both now and in the long term. Now, technical traders might not act fundamental analysis, but they always need to be aware of it. Now, the whole point here is this: fundamental analysis is basically looking at the health of an economy. What are the job reports? What are the average earnings? How many people have jobs compared to last month? How many jobs were created? How much retail sales were sold last month? Uh, what are the interest rate level? What is the inflation on the economy? Now, remember that as a trader, you're buying healthy economies and you're selling the weaker one, basically. You're buying healthy companies as well if you're trading shares. That's exactly what fundamental does. It analyzes the market, gives you a direction of the market based on macroeconomic factors, and most importantly, based on we're talking a combination of social or political factors. Traders that trade day to day keep a close eye on fundamentals as well as long-term traders. Now, the opposite be the case, technical. Now, technical is essentially opposite to fundamentals. Fundamentals are lagging most of the time. Fundamentals are basically indicators that tell you that show you what happened in the previous month. So they're lagging behind. There's things that have happened. Technical, on the other side, analyzes basically it involves the analyzing of charts and technical patterns of behavior. For example, all what technical really does is it looks for future prices based on past prices. Now, it doesn't really care what a politician is about to win the elections in South Africa. Well, technical doesn't really care much about that. All technical looks at is price movement. The price moved to $2 2 days ago. It came down to $1 yesterday. Today it's on $3. Price movement is all that is being looked out for. Repeated patterns of behavior that repeat themselves. Now, technical analysis is based on the study of price actions. As everything in the market, all the instruments are represented in price. Now, for some traders, this is preferred method of analysis, obviously, but the debate keeps looming on and on and on in regards to which is better. Now, that's just about it for today's webinar. I would like to do a recap. In the meantime, I would like to see a couple of hands raised from the audience. I'd like a couple of questions coming as well. O'Neill Senior, got your hand raised. Amazing. Let's identify a couple of audience in the house with hands raised. Go ahead and raise your hand if you've got I see Patel. Okay, you're joining us. Great. Patel, as promised, I will tend to your questions via email. Definitely. I've got also, okay, I've got Duke with a question. Um, Okay, there we go. I'm gonna send emails to certain questions that are very lengthy for us to deal with here. I want the audience to keep in mind that you will have a survey on your way out of this webinar. A survey, you just need to fill that up. My email address is on the screen right now as we speak. Please feel free to drop me an email. If you're interested in a recap, can we see some hands raised? If you're interested in a recap, amazing. We're getting some hands raised. Jose Cord interested in a recap. Okay, great. We've got a couple more people. Peter interested in a recap. Samantha interested in a recap. Sarah is interested in a recap. Anybody else interested in a recap? Okay, a couple more people interested. Okay, let's do a real quick recap in regards to everything we went through. So we started with terminologies. We spoke about spot forex. That's what we do here in EverFX. That's what we provide here. Spot forex is where you can get your exchange instantly. Now we looked at percentage and point. Essentially, this is how you understand what your trade is worth, how much you're making for every time the market moves. It goes up, it goes down. That's how you understand it. And then we learned that most pairs actually come in the 4 digit from the left. That's how you count your pip. You understand what your pip is. For the yen pairs, is quite different. Looking on your screen, yen pairs are usually the second digit from the left. Once that moves, for example, it goes from 9, goes down to say 5. The market just moved by 4 pips. Okay, and the same thing with the yen pair, and the value of your trade depends on that as well. Now, we looked at lot value, which is essentially your input into the market. Very important to understand what you're putting into the market. A standard lot is referred to about 100,000. Depending on the base currency you're trading, that's where you've got your value. So if you're trading the US dollar JPY, 100,000 US dollar. If you're trading the British pound US dollar, the cable, then you're talking about 100,000 pounds. These are different lot sizes, and we went back to pip value and margin. Margin essentially is what you're putting into the market. Essentially, what you put in has to have a value. Well, it has to have a value based on the leverage. If you're trying to get a jacket worth $1,000, if you're getting a leverage of 1 to 10, it means that for every $1 you got $10 to get that jacket. It means you need about $100 to get that jacket. That's how leverage works. Now, that $100 is your margin. The amount of capital needed to get that asset, to get that trade open, even though you're not getting it at its real price. You're getting what we can call an assistance leverage. Well, this is how the system works essentially, because the market works in huge volumes as well. So leverage is important. We're looking at currency pair. We understand our base currency, quote currency. We're always, whatever action we take on the platform, a buy or a sell, is always referred to in the base. So if you're selling the base. If you're buying the base, and vice versa to the other side as well on that trade. Okay, like it says here, as the pair moves lower, the base is getting less expensive, and you're looking to buy the pair if you think it's going higher. You're looking to sell if you think it's going lower. Now, currency pair, if you think about it, just about the same like we said. That's how it works. You're buying and you're selling. You're getting something else in return. Major currencies, high volume. For attending this webinar, you will get a presentation in order for you to, or you can request for it. You can request for a presentation directly. In order for you to get a copy of this, you can go through by yourself as well. That's one of the perks you get for attending this webinar, and you will also be entitled to a session with me. Just drop me an email and we will make it happen. Now you got minor currency pairs. Always remember the majors come with the US dollar. As long as it's got the US dollar, it is a major. Now without the US dollar, you got minors. You got 8 major currencies, well 7 without the dollar, all paired up together, and that's the value you get right there. Now there are certain notable characteristics of currency pairs, like the Japanese yen and the Swiss franc are safe haven currencies. Most currencies are not correlated. Some of them are indirectly correlated. Now, cash accounts and margin account. Difference will be cash account. You can sort of call it old school. It's like you go in one way on a trade and you can go the other side of it. But the margin, you can make, you have a potential to make money if the trade is going up, if the market is going up, the value is increasing, and if the value is reducing. With a cash account, you cannot. It's one-sided, and you've got no leverage as well. That's one of the most attractive things about trading CFDs with margin accounts. Now, fundamentals and technicals, it's got a very, very broad perspective. It's not something you can basically let's see. It's not something you can actually get the hang of all at once. You do need assistance. Remember, we're providing you free assistance, free education. All you need is to request for it, and an account manager will get in touch with you. Take advantage of that. Fundamentals is just looking at the general scope of the macroeconomy in order to decide what you're going to do on your trade, a buy or sell. And the technical is basically not looking at the macro scope, but literally only what goes on in the market itself with the price. You're looking at the price, and essentially with the market price, you're determining your next move in the market. Now that's it. My email address is here. Thank you so much for joining us for this webinar. All questions will be tended shortly. For Samantha, Sarah, we've got John as well, Jonathan. Jonathan has a question in regards to the link and the app. The others have got several questions, as well as Patel. Your questions will be tended to via email, and we do have a one-on-one session. I, for one, don't appreciate emails so much because an email doesn't talk back. I, for one, would rather have a person on the other side of the phone, that can tend directly to your needs. It was a pleasure having you guys on board. Thank you very much for joining us. Remember, we're having webinars like this every Wednesday, same time. Look forward to having you guys on board even more. Please feel free, drop a question or two, and we'll take care of it on a later date. Thank you very much for joining us. Have a pleasant night, and I hope to see you guys next week.